Welcome back. Honeywell's Q3 2025 report is not just about beating estimates. It's about the aggressive execution of a massive strategic plan.
Absolutely. They're carving the company into three distinct, powerful entities. It's a huge move.
We're diving deep into the numbers today and confirming the critical, specific details of those spin-offs.
Yeah, there's a lot to unpack there.
So if you're an investor watching this, stay till the end, because what Honeywell is doing right now could really shape the future of industrial innovation.
Definitely worth paying attention to.
Okay, let's unpack the Q3 scorecard first.
Yeah.
Because like you said, they didn't just hit targets, they actually beat the high end of their previous guidance.
Right. The top line was strong. $10.4 billion in sales.
Which works out to 6% organic growth year over year. That's pretty solid. Confirms demand is holding up.
Exactly. And that strength carried through. Adjusted earnings per share, AEPS, that jumped 9% year over year.
$2.82.
$2.82. Again, it beating their own high-end forecast. And segment profit was up too, 5% to $2.4 billion. Good numbers overall.
But, if you're looking for the real story in Q3, it feels like it's less about the last 3 months and more about what's coming next, the visibility.
Oh, absolutely. Look at the orders.
Orders surged an incredible 22% year over year. 22%.
That's massive. I mean, that is probably the single most important metric in this whole report.
Because it pushed the backlog to a new record, right?
A new record, $39.1 billion. Think about that. When your backlog is that big, I mean, you've got incredible clarity on revenue for, what, maybe the next 18 months?
That's a pretty comfortable position for an industrial company these days.
It really is. Very rare.
Okay, now, let's touch on cash flow, because the numbers might look a bit confusing at first glance.
Yeah.
You need to clarify this.
Yeah, definitely.
Operating cash flow looked great, $3.3 billion, up 65% year over year. Huge jump.
Right.
But then the headline free cash flow, FCF, that actually came in lower, $1.5 billion, down 16% year over year. So what gives?
You're right. That $1.5 billion FCF figure is, it's misleading on its own. The crucial thing is that number doesn't include the huge chunk of cash they got from Resideo.
The agreement termination. How much is that again?
$1.6 billion. Cash. So, yeah, the reported FCF looks lower operationally, but the company actually pulled in significant net cash. The underlying position is much stronger than that headline number suggests.
Got it. That definitely clears things up, makes the overall cash story much stronger.
Much stronger.
Okay, so let's drill down into the segments now, because this is where you start to see maybe the stresses and strains that justify this whole massive spin-off plan.
Exactly. The performance isn't uniform across the board.
Let's start with Aerospace Technologies, AT. That was the growth engine, no question. 12% organic growth.
Yeah, AT was flying high, and it was premium growth too, driven by a massive 19% surge in commercial aftermarket.
So planes needing parts and service.
Basically, yeah. Older fleets needing maintenance. Plus, defense and space was solid too, up 10%. Really strong top line for Aero.
But wait a second. If revenue growth was that strong, 12%, why did the segment margin actually contract? It dropped 160 basis points, down to 26.1%.
Yes, the catch.
Isn't that a bit of a red flag? Kind of dampens the excitement over that growth number.
It absolutely is the main headwind, no doubt. Despite all that revenue pouring in, AT faced pressure from, persistent cost inflation. We keep hearing that theme.
And integration costs too, right?
And integration costs from previous acquisitions, yes. So they're growing fast, but it's just getting more expensive to run that business right now.
Okay. So strong growth, but margin pressure in Aero. What about building automation, BA? Seems like maybe a quiet achiever.
I think that's fair. BA was solid, 7% organic growth, steady.
And the margins.
That's where they really shone. Highest margin expansion in the whole company, up 80 basis points.
Wow. To what level?
An industry-leading 26.7% margin. Really impressive.
What drove that?
It was mostly volume leverage, getting more efficient as they sold more. And their fire products business just keeps performing. 4th straight quarter of double-digit growth there. Reliable, high-margin stuff.
Okay, BA looks good. Now let's pivot to the pressure points, the areas that maybe highlight why they need this simplification. Industrial automation, IA.
Yeah, IA definitely struggled more. Only 1% organic growth. Pretty sluggish.
And the margins followed, I assume?
They did. Major margin compression there. Shrank 150 basis points down to 18.8%.
Ouch. And the culprits?
Same story, really. Persistent cost inflation plus some macroeconomic weakness, particularly in Europe. That hit their productivity solutions and services business, PSS, pretty hard.
Was there anything positive in IA? Any bright spots?
Well, yeah, their sensing business held up well, and warehouse automation actually saw double-digit orders growth. So there are definitely pockets of strength, things that are mission critical, but overall the segment performance was a drag.
Got it. And the last piece, Energy and Sustainability Solutions, ESS. How did it fare?
ESS actually saw a slight decline, 2% organic sales decline.
Why was that?
Mostly issues within their UOP business. That saw a 13% drop in sales.
And UOP is their big licensing and catalyst business for refining and petrochemicals, right?
Exactly, the heart of that offering. They ran into some anticipated licensing delays and shipped fewer catalysts. That was the main driver of the decline.
How did the margin hold up?
Margin was flat, actually, 24.5%. But there's a caveat.
Always a catch.
Yeah, it was helped by a one-time government legal cost reimbursement, so underlying profitability might have been weaker.
Okay, so big picture on segments. Aero growing fast, but costs are rising. BA is the steady profit star. IA is sluggish with margin pressure. And ESS had UOP issues dragging it down.
That sums it up pretty well. And you can see the internal strain, right? The volatility, the cost pressures, the uneven growth. It makes the case for why management felt they couldn't just keep things as they were.
Absolutely. It forces the hand for this massive reorganization, this three-way split.
Which is moving fast. They're targeting full completion in the second half of 2026. 3 distinct publicly traded companies.
There's an aggressive timeline. And the first piece, the Solstice Advanced Materials spinoff, that's happening like right now, end of October 2025.
Yep, completion set for October 30th. And the structure is interesting for shareholders.
How so?
Well, Solstice shares get distributed to current Honeywell shareholders. It's a 1-for-4 ratio. And financially, Solstice is sending a big dividend back to Honeywell, $1.5 billion.
And Solstice itself is set up independently.
Yeah, they successfully raised debt capital, got the highest non-investment grade rating. They're ready to operate solo.
Now, this spin will impact Honeywell's numbers this year, right?
It will. It's expected to knock about $0.7 billion off full-year sales, 0.21 off AEPS, and 0.2 billion off FCF. It's a noticeable hit.
But here's what's fascinating, isn't it? They're taking that hit, shedding a decent-sized business.
Right, absorbing that drag on sales and earnings.
And they still raised their overall full-year guidance. We'll get to the specifics later, but that signals some real underlying strength in the remaining core businesses, doesn't it?
It absolutely does. The core must be performing well enough to offset that loss, and then some. Very telling.
Okay, so Solstice is basically done. What about the Aerospace Technologies spinoff? That's the bigger one, slated for the second half of 2026. What's the thinking there? Separate the growth engine.
It's really about maximizing valuation, you know. By spinning AT off, the idea is it becomes one of the largest pure-play aerospace suppliers out there.
Focused.
Exactly. It can focus intensely on those big secular trends like electrification of flight, autonomy, stuff like that, things that investors tend to reward with higher multiples without being, dragged down by the industrial or energy businesses.
Makes sense. And we should expect more news on that soon. Leadership, HQ.
Yeah, they said an announcement on leadership and headquarters for the new Aero company should come before the end of this year, so keep an eye out for that.
Okay, Aerospin in late 26. That leaves the third piece, the RemainCo reorganization. This is what's left, becoming the automation pure play.
Right, and they're already making internal changes to set the stage. Starting January 1st, 2026, Honeywell internally shifts to 4 segments: AT, BA, IA, and a new one, Process Automation and Technology, or PAT.
So that's the interim structure. But after the Aerospin happens in late 2026, what does the final automation pure play look like?
It'll be focused on 3 key segments initially, but the core will really be PA&T and IA. PA&T is estimated around $7 billion in sales, heavily reliant on recurring revenue. Think aftermarket services, maybe 60%.
And IA?
IA is the other main block, estimated at $6 billion, more focused on mission-critical hardware, maybe 70% products, 30% solutions.
And we should probably mention they're still simplifying even within that structure, right?
Yeah.
They started looking at options for PSS and WWS back in July.
Good point. Productivity solutions and services, that's kind of the legacy barcode scanner, mobile computer hardware stuff. And warehouse and workflow solutions is more the software side for logistics.
Evaluating strategic alternatives usually means?
It usually means they're seriously considering selling or spinning off those parts too. So that final $13 billion automation portfolio could get even more focused down the line.
Interesting. Lots of moving parts. Okay, speaking of things maybe flying under the radar, let's quickly talk tech investments and balance sheet stuff. Quantinuum.
Ah, yes, the quantum computing venture. That's showing some serious validation.
How so?
They just raised over $600 million. And the valuation, $10 billion pre-money.
Wow, that's double the previous valuation, isn't it?
Double. And they landed a strategic partnership with NVIDIA. That's huge validation. It shows they can actually succeed in commercializing really advanced, future-focused tech outside their traditional industrial base.
Big win there.
Yep.
And on the balance sheet, they clean things up too. We mentioned the $1.6 billion cash from Residio.
Right. Plus, they also announced they're divesting the legacy asbestos liabilities related to the old Bendix business.
So this isn't just about cash, it's about risk reduction.
Exactly. Strategically shedding these old environmental and legal liabilities, it makes the balance sheets of the new spin-offs, and especially the remaining automation company, much cleaner, much more attractive for investors going forward, takes away potential headaches.
Okay, that makes sense. But we still need to circle back to that overall margin pressure before we hit the guidance update. Despite all the strategic moves, overall segment margin did contract by 50 basis points.
Yeah, that's the key operational headwind, the caution flag. Cost inflation is a persistent theme across the business.
And the UOP issues contributed too.
And the volume deleverage in UOP from those licensing delays we talked about. So yeah, management definitely has work to do to get those margins stable or expanding again heading into 2026.
All right, let's tie it all together then. The updated guidance. This feels like the ultimate signal of management's confidence, right? Raising full year 2025 guidance even after accounting for the Solstice spinoff hit.
It's a powerful signal, absolutely. Shows confidence in the core.
So what are the new numbers? Sales?
Sales now expected between $40.7 billion and $40.9 billion. And they lifted the organic growth forecast slightly to approximately 6%.
Okay, and the bottom line, what does it mean for earnings?
Adjusted EPS range was crucially raised, now $10.60 to $10.70 per share.
So they fully absorbed that estimated 21-cent hit from Solstice and still raised the range.
Exactly. Confirms that underlying strength we talked about. Core operations must be doing well.
But the caution remains on margins.
Yeah, the guidance for segment margin expansion was actually narrowed and slightly lowered, now expected up 30 to 40 basis points for the year. That reflects that ongoing cost inflation headwind, maybe 50 to 70 basis points of pressure.
And free cash flow.
FCF guidance was maintained, still $5.2 billion to $5.6 billion, so holding steady there despite everything.
Okay, so with that guidance in mind, let's quickly think about the future scenarios investors might be considering. What's the base case?
Base case is basically things go according to plan. That strong $39.1 billion backlog drives the sales. Cost inflation stays as a headwind, maybe 50, 70 basis points that they signaled. Spin-offs happen smoothly.
And the outcome?
You hit the midpoint of guidance, AEPS around $10.65, organic growth around 6%, margin expansion about 35 basis points, the stable expected path.
What about the bull case? The upside?
Bull case is AEPS hitting the high end, $10.70. That probably needs a few things to go right. Maybe the global economy picks up faster, especially in Europe.
Aerospace margins stabilize quicker than expected.
Yeah, or those UOP licensing issues clear up fast, maybe late this year or early next. And critically, the spin-offs maybe get valued higher by the market than people currently expect. That could really boost sentiment.
So strong performance enabling a good setup for 2026 guidance too.
Potentially, yeah. Maybe setting up for over 7% organic growth next year. FCF hitting the high end of $5.6 billion this year. That's the optimistic view.
And the bear case, the risks.
Bear case is AEPS hitting the low end, $10.60. The big risks are a sharper macro downturn hitting those big projects in IA and ESS. Or maybe margin pressure gets even worse than expected.
Spin-off delays or problems.
That too. Delays or unfavorable terms on the spins could hurt. The outcome there is organic growth maybe dips to the low end, around 5%. And it means the new automation pure play starts life in 2026 on weaker footing.
Okay, so if we synthesize all this, what are the absolute key takeaways for someone watching Honeywell right now?
Number one, undeniably, the backlog is king. That 22% order surge, the $39.1 billion number, that provides incredible visibility for the next, say, 18 months. Huge asset. Aerospace transformation, that booming commercial aftermarket up 19%. It just validates the value there. It confirms the spinoff in 2026 makes sense. Create that pure play leader. Aim for a higher valuation multiple.
And the Quantinuum news.
That's number three, the quantum validation. The $10 billion valuation, the NVIDIA partnership, it shows they can successfully grow these high-tech ventures outside their traditional areas. It's proof of innovation potential.
But there's always a but. the caution flag?
The caution flag is definitely the overall segment margin contraction, how well they manage and offset cost inflation. That's probably the single biggest factor determining if they hit the high or low end of guidance. It's the key operational challenge.
Yeah, the overall strategic narrative.
It's all about radical simplification, right? Unleashing value. Give Solstice, give Aerospace, give the remaining automation company the focus, the capital structure they need to perform best in their specific markets.
Okay, final provocative thought then. We talked about the remaining company becoming this automation pure play, mainly IA and PAT.
Right.
But remember, they're actively looking at strategic alternatives for the PSS and WWS businesses within that.
Yeah, the barcode scanners and warehouse software stuff.
So how focused could that final, maybe sub-$13 billion automation portfolio actually become? And if they do sell off PSS and WWS, what could that extra cash infusion mean for the remaining automation business? Something to think about as this massive restructuring continues to unfold.
Definitely something to watch. Could lead to an even leaner, more focused automation player in the end.
All right. Just a reminder for everyone listening, we are not certified financial advisors, and this content is only for educational purposes.
That's right. If you are considering making any investment decisions, please be sure to consult with a certified financial advisor.